$995. That's the profit from a single cash-secured put on SNDK that ran for 5 trading days. Sounds clean, right? Here's the part they don't tell you up front. At one point during this trade, the stock had dropped nearly 30% from entry and was sitting just $40 above the strike price, with 2 days left on the clock. So how did this cash-secured put close green? Stay with me because this one is worth understanding. Here's exactly how the position was built. A mole sold to open one contract of the SNDK July 31st, $1,050 put. One contract covers 100 shares. The premium collected was $10.40 per share, so on one contract that's $1,040 in premium received into the account immediately. Total capital at risk on a cash-secured put is the full strike obligation, 100 shares at $1,050, which is $105,000 tied up as collateral. The break-even at expiration is the strike minus premium collected, so $1,050 minus $10.40, giving you a break-even of $1,039.60 per share. Meaning SNDK had to close above that level at expiration for the trade to be profitable. Max gain on this trade was capped at the full $1,040 in premium, and a mole closed it for $995. Look at the stock price chart, and this tells a dramatic story. Entry on July 24th at $1,437. Then, over the next 3 sessions, July 27th, 28th, and 29th, the stock falls off a cliff. It closes at $1,278, then $1,196, then drops intraday to within $1 of the strike on July 29th, closing at $10.15. That's a plunge from $1,437 to $10.15 in 3 days. Then it bounces, $12.80 on July 30th, and exits at $12.20 on July 31st. Brutal descent, partial recovery, and the cash-secured put still closed profitable. The exit on July 31st came with the stock at $12.21, still well below the entry price of $14.37, and meaningfully below the pre-trade highs near $1,700. The stock did not recover to entry levels. It did bounce off the lows, which is what allowed the put premium to collapse from 45 cents at close versus the $10.40 collected at open. Amal did not wait for expiration. He bought back the put early, locking in 96% of max premium. Leaving $4 on the table was the right call, given how violent this move had been. Here's what this trade teaches, and be honest with yourself when you hear it. Selling a cash-secured put on a stock with 150% annualized volatility is not a passive income trade. It is an active risk management challenge. The premium was rich because the risk was real. SNDK dropped 30% in 3 days. The strike was breached intraday, a loss alert fired, and yet the trade closed profitable, not because of luck, but because of 3 specific decisions. First, the strike was set at a level that provided real cushion, 27% below the stock price, and the stock bounced before expiration closed it in the money. Second, the duration was short. 5 trading days means time decay works aggressively in your favor, and you're not exposed to long drawdown periods. Third, the exit was disciplined. When the stock recovered on July 30th and 31st, and the premium had collapsed to 45 cents, Amal took the 96% of max profit and closed the position. He did not get greedy, waiting for the last dollar. If you're going to sell CSPs on high volatility names, you have to size correctly, choose your strikes with genuine conviction, and have a plan for when the stock moves against you. That's the sensible trade for this week. If you want every episode breakdown, trade structure, and lesson in one place, head to the-sensibletrader.com and subscribe. Follow us on Twitter for daily trade ideas and market insights. And remember, every trade, win or lose, is data. You are getting better every time you sit down and do the work.